Hey everyone, and welcome to The Explainer. Today, we're cracking open the case files on a massive, truly global issue. We're talking about something that drains trillions, yes, literally trillions of dollars globally every single year. It's a topic that affects absolutely every organization in the world, whether they actually realize it or not. We're going to demystify the complex, often hidden, and honestly, surprisingly fascinating true crime world of corporate fraud. We'll be breaking down the precise anatomy of these crimes, the psychological triggers that cause them, and the systematic defenses used to stop them. It's kind of chilling if you think about it, right? What exactly turns a trusted, everyday employee into a corporate fraudster? And we aren't just talking about, shadowy, anonymous hackers operating in dark basements. We're talking about the friendly accountant down the hall, the quiet warehouse clerk, or even the highly respected CEO. That is a core question we are investigating today. We're going to look at the who, why, how, and what now of organizational crime, mapping out how this seemingly impossible becomes a reality right under management's nose. Okay, let's dive right in. Here is our roadmap for the investigation. We'll start by surveying the modern fraud landscape, unpack the psychology behind the crime with the fraud triangle, look at common types of fraud, learn how to spot the red flags, and finally, examine the internal defenses organizations use to protect themselves. Section 1. The Fraud Landscape, a Digital Expansion. So we have to understand that widespread digitalization has completely blown the doors off the traditional fraud landscape. By creating countless new digital entry points, everything from cloud systems to the smartphone in your pocket, the traditional perimeter of an organization has basically vanished. And more entry points just mean more vulnerabilities, empowering a vastly larger number of bad actors all over the globe. A huge part of this involves email-based threats, specifically phishing and spoofing. Just imagine getting an urgent email that looks exactly like it's from your company's HR department. It's got the correct logos, a perfectly copied signature, and it's asking you to verify your direct deposit link. That right there, that's spoofing. Now, when you click that link and enter your credentials into a fake portal designed to harvest your passwords, the trap snaps shut. That is phishing. And fraudsters have rapidly evolved these tactics, bringing the threat directly to our personal devices. We now face spear phishing, which is highly targeted. That's like a scammer targeting the CFO directly by referencing an actual vendor the company uses. Then there's vishing, which might be a panicked phone call pretending to be your IT help desk demanding your login. Smishing uses deceptive text messages, like a notification claiming your urgent package delivery just failed. And quishing tricks users into scanning malicious QR codes. Imagine a fake QR code slapped right over a real one on a city parking meter. You scan it, and it downloads malware straight onto your phone. Wild, right? Moving on to Section 2, the Fraud Triangle, the Psychology of a Crime. Okay, let's pivot from the digital tools to the human mind. To truly understand fraud, we absolutely have to analyze the psychological profile of the fraudster and the specific conditions that must exist for a crime to actually happen. According to the source material, there are 3 characteristics ordinarily present when an intentional deception takes place. Those are pressure, opportunity, and rationalization. Without all 3 holding up the structure, the fraud usually just collapses. Let's break down each side of that triangle with a real-life scenario. Imagine an employee drowning in sudden, overwhelming medical debt. That is intense, unyielding pressure. Now imagine they realize the company's expense software automatically approves anything under $500 without a human ever checking the receipts. Well, that is a glaring opportunity. Finally, they tell themselves, you know what, I've worked unpaid overtime for years. The company practically owes me this money anyway, and I'll pay it back as soon as I can. That mental gymnastics, that is the crucial psychological mechanism of rationalization. Practitioners often view this model as overlapping circles. While having even one of these factors present is for sure a warning sign, you really have to watch for the perfect storm. When you have a situation where a deeply motivated employee with a convincing rationalization is suddenly presented with a clear, easy opportunity, when all 3 circles overlap, an ordinarily honest person can easily cross that line into criminality, and the risk of a fraud event becomes extremely high. Section 3. Common types of fraud. Weapons and tactics. So, now that we know the why, let's get into the highly detailed real-life mechanics of how complex financial fraud is actually executed. One classic example of asset misappropriation is a scheme called lapping receivables. Let's imagine an insider. We'll call him John. He's an employee who opens the Daily Mail and also happens to update the accounting ledger. John is about to start a continuous, utterly exhausting shell game of moving money around just to hide a theft. Let's see how this builds step by step. First, John steals a $1,000 check from customer A to pay off his own credit card debts. But obviously, customer A expects their account to be credited. So when customer B mails in their $1,000 payment a few days later, John secretly applies customer B's money to customer A's account. Now B is short. To cover B, he steals from customer C. It is a literal treadmill of theft. He can never take a day off because if someone else covers his desk and answers a customer complaint about an unposted payment, the entire house of cards collapses instantly. Another highly tactical example from the text is check kiting. This is an ingenious, though highly illegal, method of exploiting the float. The float is just the processing time it takes for banks to clear checks. Why does this float exist in the first place? Well, banks want to provide good customer service, so they often make funds available to you quickly, long before the actual digital or physical clearing process finishes behind the scenes. Kidders exploit this gap to essentially invent money that doesn't actually exist. Here is the exact timeline of how this two-step process works in practice. On Monday, our fraudster writes a $10,000 check from Bank A, fully knowing that account has $0 in it. On Tuesday morning, they deposit that bad check into their account at Bank B. Because of the float we just talked about, Bank B assumes the check is good and immediately credits the account $10,000. On Wednesday, the fraudster withdraws the $10,000 in cash. By Thursday, when Bank A finally communicates to Bank B that the check bounced, the fraudster is long gone with the money. But notice the stark contrast in the nature of these crimes based on who is actually committing them. Low-level staff fraud generally involves stealing physical property, petty cash, or merchandise. A warehouse worker stealing inventory might cost the company thousands, usually intended to relieve direct economic hardship or maybe feed a habit. Executive fraud, however, is completely different. Executives usually misstate the financial statements, like recording fictitious sales or hiding massive liabilities. Their incentive isn't stealing petty cash, it's inflating the company's stock price to trigger massive personal bonuses. A CEO cooking the books to hit earnings targets can cost shareholders billions, billions with a B, just like we saw in massive historical cases like Enron or WorldCom. They manipulate the numbers to benefit the organization on paper, which ultimately enriches them. Section 4, Spotting the Red Flags, Warning Signs of Crime. Since we know these crimes are happening out there, we now have to put on our detective hats. How do organizations actually look for the symptoms? The sources categorize these warning signs into 3 distinct areas. First, document symptoms. This means physical tampering, like photocopied invoices where the ink looks altered, or ledgers that magically balance to the exact penny without fail every single time. Second, lifestyle symptoms. Imagine a mid-level clerk suddenly driving a $100,000 sports car or posting photos from a multi-week luxury vacation that far exceeds their known salary. And third, behavioral symptoms. The sheer guilt and stress of perpetrating and hiding a major fraud often causes noticeable, drastic changes in a person. The perpetrator might become hyper-defensive, develop a substance problem, or, like our friend John, completely refuse to ever take a sick day because they're absolutely terrified someone will uncover their lapping scheme while they're away. Zooming out to the organizational level, there are general red flags investigators look for too, like missing documents, excessive voids at a cash register, or a sudden, rapid turnover of financial executives. A very specific one is splitting purchases. Take a company procurement policy, for example. If an employee knows that any expense over $5,000 requires vice president approval, they might take a fraudulent $8,000 purchase and split it into 2 $4,000 invoices just to fly completely under the radar. Remember, these flags don't definitively prove a crime has occurred. They are smoke. But where there's smoke, investigators must look for fire because it signals that an opportunity for fraud exists. Finally, Section 5, the defense against fraud. Management, and auditors. For our final chapter, we're looking at how an organization constructs its internal defenses to manage and mitigate these intense risks. The defense relies on a very strict division of labor. First, the board of directors sets the tone at the top and determines the organization's appetite for risk. To give a real-life example, if the board actively turns a blind eye to minor ethical lapses just to hit quarterly sales goals, employees will internalize that toxic culture, and that drastically increases fraud risk. Second, it is management, not the auditors, but management, who actually own the responsibility of preventing fraud and building daily internal controls. Finally, internal auditors act as the third line of defense. They evaluate how effectively management has designed those controls, looking for the red flags we just discussed. So, the absolutely crucial point here is that to be effective, these auditors must rely on a concept called professional skepticism. They cannot just take things at face value. For instance, if an auditor asks a department head for a missing vendor receipt, and the manager casually says, "Oh, the dog ate it, don't worry about it." Professional skepticism means the auditor doesn't just nod and move on. They assume internally that this could be a deliberate cover-up, and they critically assess the reliability of all information. They dig deeper until they have hard evidence, constantly assuming that control deficiencies could be opportunities for fraud. Trust, but verify. Which brings us to our final takeaway. The source material states unequivocally that even if no characteristic of the fraud triangle seems to be present, the risk of fraud can never be completely eliminated. Even the absolute best, most effective internal controls can sometimes be circumvented by two employees secretly working together. So I'm leaving you with this provocative thought. Considering the constantly evolving digital landscape, the mounting financial pressures people face, and the sheer complexity of human behavior, how secure is your organization really? Thank you for joining me on this explainer, and remember to keep your eyes open.